That's the first thing you want to do. You want to create a budget. You want to throw all extra cash, which there's really no extra cash. But when you alleviate those bills from your budget, your Netflix, your Hulu, your internet streaming TV, and the only thing I would really say that you probably need, because I'm not gonna lie, I feel like I need it, is Wi-Fi. You throw all of that money that you have released from those monthly subscription bills and you throw at your debt. Okay, your smallest debt first. That's called the debt snowball. Then you need to have a good savings plan. Okay, you need to have a good savings plan, because there may be a time where you might have to leave your job, where you don't have enough money to cover your bills for a certain amount of time. The goal is 6 months, at least 6 months. The bare minimum is 3 months. Because at the end of the day, if you have to leave your job because of death in the family and they're not going to give you that time, or bereavement time, you may not have it, or you may get fired, or they may just lay you off, or they didn't renew the contract. There's so many reasons why you might not have a job. So you want that 6 months of all your bills inside of a high yield savings account ready to pay off those bills, so you're not getting put out in the cold or in the heat, depending on where you are. So that is a precautionary thing to do. Then you want to invest your money. You want to diversify your investments on all scales across the investment market. I'm talking about individual stocks, index and ETFs, bonds, commodities, and real estate. You want to have a very diverse portfolio, because I've said it before, and I'm not trying to, what is the term that people use? I don't know, when you give something bad luck, I forgot what you call it. I'm not trying to make it come. It just, statistically, it comes around the 10-month part where the stock market crashes. Don't forget, between 2008 and 2009, the stock market crashed, and we're due for one. Okay, so I would say in the next 2 years, we're due for a stock market. And you know, your buddy in the White House, he's gonna say, oh, it crashed because I didn't get reelected. But who knows? I'm not voting for him. This is me. I have my reasons. Okay, I have my reasons why I'm not voting for him. You might have your reasons as well. But the stock market this year it's been doing primarily pretty good. Okay, primarily pretty good, but not as good as I think. So let's take a quick look at the stock market. Bear with me, guys. I'm gonna see if I can show you guys the stock market and how's it doing. I'm gonna show you some top investments here. You're gonna look at my desktop if you don't mind. Go. Okay, I think I got it in here. Now, and we're looking from, this is on CNN Business Markets, and we're looking at the Dow. We have the Dow at 0.43% up, $27,000. Now, granted, I want you guys to understand how the stock market has been. Now, from my little research I've done, and I could be quite wrong here, from 1931 was the first stock market that Belgium made, the first form of a stock market, okay? Now, to this day, stock markets have been crashing anywhere from 10 to 12 years. And for the American stock market, it has been exactly the same. Every 10 to 12 years, we have a crash. But the stocks come back and they always break old records. What does that mean? That the stock market consistently grows. Look at Apple, they're up. Now, they were at 249. So you also have to look at where stock went down from and where they're back up to, because that 0.214 don't mean nothing if they came from $249. And then my notorious Citigroup, if anybody knows my story about Citigroup, had all these Citigroup stocks. When the market crashed, I bought them for $4 a piece. I bought like 300 of them. Then the Citigroup stock dropped down to $1. And I told my buddy, hey man, I'm selling all my Citigroup. He said, do not sell your Citigroup. The government is not going to let the banks and car industry fail. I said, nah, man, nah, they will. We don't have the money. I sold them all. Look at Citigroup now. This thing, I bought Citigroup for $4, okay? For $4, and now it's worth $73. I had 300 stocks. I'm gonna let that sink in for a second. Now, you have GE, and look at Google. Google is worth $12.64. Got Microsoft in here. Just to give you guys, here's the world markets and how they're doing. Now I'm gonna go back up to, let's see the losers. Yum Brands, Nordstrom. We're just gonna take a small look here. What emotion is driving the market? Fear, neutral, and greed. So extreme greed is driving the market right now. Now, if you notice, when the market is balanced, it's neutral, greed and fear, meaning people are doing more safe investments. Right now, because the stock market is doing primarily well, greed is driving it. That means that people are taking more riskier investments. Now, when it comes to fear, that means that people are doing more index ETFs and bonds because fear is driving the market. Look how the stocks are doing in 2019. The Dow is up 16.5 points. The NASDAQ is up 25%. The S&P 500 is up 21.5 points. Now let's do a little deep dive on Google here. So let's look at Google. Now, if you look at the trend here, when you have your analysis tool and you see your graph, how it goes up and down. And this is the basis of the stock market that I really need you guys to focus on. But the key term or the key number I want you keying in on is the top right, where I'm about to highlight here, right here. Year to date, that means from the inception of Alphabet, aka Google, because Alphabet is the parent company of Google. I think they did that for investment and also tax reasons, but Alphabet is just Google. 20.65%. That means if you have invested with Google when they first started, that means that your stock rose 20%. We have to think about investment as long-term, not short-term. A lot of times people ask me, how can I get rich quick by investing? Well, let me tell you, there's a couple of ways. One way is that you become a person who can predict the future. That's one. So we know that's not likely. The other one is you invest in solid investments and also some riskier ones. And some of the riskier ones may pay off. But in order to become a millionaire overnight of investment, that means that you're going to invest a large sum of money into riskier stocks, and then boom, those stocks growth 100, 200, 300% in one night, and you make that money and then you sell them. But what's the likelihood of that? Like, it's one out of a billion, one out of a trillion, because then you're gambling. And anytime you gamble in a stock market, you lose. See, that's the thing. When you try to gamble the stock market, you will lose. Now, day traders, most of them are more knowledgeable of how they do their investments, because day by day they are selling and buying. And if they believe they made $1 on a stock, they're going to sell that stock, because all the while they are accumulating money throughout the day. But here's the thing. They're on their computers from the time that the stock market opened until the time the stock market closes. They barely take bathroom breaks. They barely eat, because the only thing they're doing is trading stocks all day long. So if you're not going to be a day trader, the way to go about these stocks is slow growth, meaning you want to do solid investments and you want to be diversified through across the markets. Now let's look at Microsoft. Let's look at their year to date. Look at this. If you would invest in Microsoft when they first started, right? Let's go to 5 years. All right, look at back in 2014, they rose up 16 points. But if you would have invested in Microsoft when they first started, you would have gained 42% on your investments. 42%. They said 5-year change, 214% over the course of time. And see that? You see those little divots within the graph here? See this right here? How it goes up. Look, follow my cursor here if you can see it. But it's going up and down, up, down, up, up, down, up, 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 down. But what is it doing all the while? It is going up. It is going up. Now, if you never could read this, one side of this tells you the dollar value. The other side of this tells you the percentage. The amount for the stock is $144.61. And today, the stock have rose $1.78, and in percentage, that's 1.25%. So this is quite easy to read, guys. This don't take rocket science. The whole thing I want to see is I'm making money. Look at 2018. They rose up 67%. Okay, let's go back. Let's look at one more, and I'm not going to bore you any longer. Let's look at Apple. I know a bunch of you have Apple phones. Let's look at Apple. And let's look at not 5 days. Let's look at 5 years. Look at Apple. You see that? Back in 2014, they lost around 12%. That don't matter though. Don't let when a stock loses value scare you off from investing, or you stop your investments, or you take your money out of those investments. Don't do that. Do not take your money out of investments unless you had to. Like there was a death in the family, there was an emergency. You got to fly across seas because something happened. Or you got to go save a family member from the Colombia cartel, whatever the case may be. But let's go through this graph real quickly. Again, the stock price is $246.75, and today it's went up $3.40. And for that particular stock, it rose 1.40%. In year to date, the entire stock has risen around 57%. Okay, 57%. You can't beat that. And again, let's be very elementary about this. Let's go over this graph. I'm just gonna follow divots up, down, up, down, up, down, up, down. Then it goes up. It's going up, down, up, down, up, down, up, down. It goes all the way up. Then it goes all the way down. You see that right there? You see that big turn right here? It went all the way up, and then like it's a cliff. It just dropped off, but look what it did. It recovered. And look at the end of it. The end of it right here where this little do not enter sign is, it's higher than the point where it dropped off at. And that's the important part. You see how stocks bounce back. I just had to give you a visual. That's all. I just had to give you a visual because that's what you need to understand, that these stocks will go up and down over the course of time. And I didn't break down. I'm gonna do a class. I'm gonna try to do a live class, and with that, you have to bear with me. All this live stuff is totally new for me. You see, just bear with me. That's all I'm gonna say. Where I'm gonna show you all the analytics of a stock. I'm gonna break it down so you like, okay, now I know what EPS mean. Now I know what RSI mean. Now when the capital and revenue and all this of a stock, you're gonna know all those things. Now, some of you, it's not going to be interesting for you because some of you are like, hey, man, I just want to know how to invest, put my money in there. I don't want to know all that stuff. But for the rest of you, you're like, okay, that's good to know information. Not need to know, good to know. But anyway, I thank you guys for joining me. If you have any questions, please leave them in the comment section. If you will, give me a thumbs up. If not, comment me to tell me how I get better. I know the music distracted a lot of you guys. My apologies. Again, I'm trying to work this thing out the best way I can. I'm gonna stop giving excuses and I'm gonna fix it. That's what I'm gonna do. I'm gonna fix it. Because if you're running hard on a treadmill, you're probably giving yourself excuses why you're not doing well. So I'm not gonna do that either. Anyway, this is Financial Literacy 101. This is Ross World. My money makes money. I'm out. I see you guys.